Hi, thanks very much. Really nice to meet everyone. Thanks for the fantastic introduction and for the invitation. This is my first face-to-face meeting in 2 years, so I'm really pleased to be here. So, my subject today is the future of money. And I'd just like to pause to suggest to you that we're in quite an interesting moment in the history of money. And how extraordinary is it that we're on the cusp of a transition from digital money, from physical money to digital money. You know, we've had banknotes for 1,000 years, maybe coins for 2,000 years. And now in our lifetimes, in our working lives, we might be able to envisage the first truly cashless societies. And what does that then say about where we are? It means that one contest, one format war between physical and digital is coming to an end, and a new format war is kicking off. Because the question before us is, what type of digital money will we have in the future? And my suggestion is that there are 5 possible paths forward. And we're really in a format war. Now, I'm over-dramatizing this just to make it amusing and entertaining. I'm not really suggesting that empires will rise and fall. But I do think there's a lot to play for when you consider the different players on the field and the different options moving forward. So what I'd like to do in the first part of this little talk is to give you an analysis of this horse race, of this format war. And then in the second part of the talk, perhaps suggest a way that we might move forward as the regulated sector. So let's examine the format war. Let's examine the runners and riders in this new competition between different types of digital money. Now, the first player on the field is the central bank. Well, actually, the central bank isn't really on the field yet when it comes to digital money. Citibank and other financial institutions, we're privileged to have access to digital central bank money, but most economic actors do not. Central bank money is extraordinarily important in the financial system. It's the root of the financial system. It's the ultimate settlement asset. And it has 2 main attributes. Number 1 is that it is free of, hold on, I just realized I'm talking very quickly. Number 1, it's free of counterparty risk. And number 2, when you exchange central bank money in, for example, RTGS systems and the target system, you have finality of settlement. So if central bank money comes to all economic actors, if essentially people have the ability to have an account with the central bank, this could be a very compelling proposition. And so maybe in the future, and I'm not just talking about Finland, I'm just asking you to think generically, maybe in the future, central bank digital currencies will become a major way that people make payments. Now let's just hold that concept in mind, that the central bank's electronic systems, their electronic money systems, become a major player. Let's look on to the second option, which is commercial bank money. Now, commercial bank money is the dominant form of digital money in the world today, some 20 times bigger than central bank money in digital form. Most of us think about, when we think about how much money do we have, we're thinking about a deposit at a commercial bank. That's a liability of a commercial bank. And it's different from central bank money because obviously there is counterparty risk. So anything over and above deposit insurance is at risk if a commercial bank fails. So this is the dominant form of digital money on the planet today. Think of all of the pipes that we have for moving around commercial bank money. Think of Visa and MasterCard and SWIFT and instant payment schemes. The world has been stitched together for the efficient movement of commercial bank money. Commercial bank money plays a dual role. It's a liability of a commercial bank that's used as a medium of exchange, but it's also the funding for risk assets. The other side of the balance sheet of commercial banks are risk assets, and everything about us is built with risk assets, is paid for with risk assets. So will commercial bank money retain its incumbency, or will it be replaced? Is it the blockbuster of money, the research in motion, the Betamax? Will it be replaced by more modern forms of digital money? Well, let's go on and examine some of the other runners and riders in the race. The next one is electronic money. And by this, you might think of PayPal type money. Now, despite the fact that all of the news stories in the past, let's say 5 years ago, have been to do with crypto, the real action has been around electronic money globally. Hundreds of millions of customers on PayPal, 300 million customers using Paytm in India, almost 1 billion customers in China using Alipay and WeChat Pay. Think of GrabPay, Mercado Pago, M-Pesa in Kenya. This is where the action has been. Now, electronic money is different from central bank money and commercial bank money in a couple of important ways. Number one, the other side of the balance sheet of PayPal is not made up of risk assets. They don't lend the money. They keep the money in segregated accounts so that they can pay it back on demand. Electronic money doesn't usually pay interest. In fact, under the e-money directive in Europe, it's prohibited from paying interest. So this type of money, maybe that's the future. Fintech money. The wind is at their back. They're gathering hundreds of millions of customers all around the world. Maybe that's the future of digital money. Now, so far, these three types of digital money that I've mentioned, the central bank money, the commercial bank money, and the e-money, they are the official sector. They're all regulated forms of money. They're all denominated in national currency units. In fact, they're all promises to pay the customer on demand at par value in national currency units. This is official money. This is sovereign money. The next two horses in the race are radically different. Now let's start with Bitcoin and other instruments like Bitcoin. So from a banker's perspective, what's the salient feature of Bitcoin? It is that it's a non-liability form of money. Now, what does that mean? Bitcoin, the Bitcoin project, it's on the first page of the white paper. Bitcoin is a project to separate money from the nation state. Bitcoin wants a world of money with no central banks, with no financial intermediaries. It's a project to sever currency from the nation state. It's a denial of the nation's prerogative to decide what money is. So because Bitcoin is a non-liability, it's not a promise to pay, it's seeking a trustless world of payments. Again, by design. Because you can't have a liability form of money and be trustless, because a liability is, I give you $100 in the expectation that you pay me back. That's a form of trust. So Bitcoin is a trustless form of money that seeks to separate money from the nation state. Now, it's always going to be volatile because it has no backing. So maybe it will never become a form of money. But having said that, El Salvador has just declared Bitcoin as legal tender. There are enhancements being made to the Bitcoin network. One is called Taproot. And Taproot is designed to power the so-called layer 2 solutions that sit on top of Bitcoin, like the Lightning Network. And the Lightning Network is specifically designed to help Bitcoin become a more efficient medium of exchange, solving the scalability and the cost and the performance issues of the core Bitcoin network. So we can't rule out Bitcoin and its other, if you like, copies or derivatives becoming a medium of exchange. That's the whole project of the crypto community. And the final horse in the race are the so-called stablecoins. Now, what is a stablecoin? Good question. There's no regulatory definition of a stablecoin. There's no regulation that defines what a stablecoin is at this moment in time, which is in force. But these instruments, they're attempting to become a medium of exchange by removing the volatility of instruments like Bitcoin. So nominally they're backed by some kind of assets. Maybe, let's say, Tether is backed by US dollars, or USDC is backed by dollars. And the idea is that if you remove the volatility, then all of a sudden you have a medium of exchange. That's the concept. Now, think about these 5 players. Think about who's on the playing field. We've got the central banks potentially about to enter the playing field. You know, you can think about CBDC as being a kind of government PayPal system. It's an e-money system run by the central bank. And central bank money could be extraordinarily compelling in a low interest rate environment, in an environment of high market stress. People might move their balances from commercial banks into the government PayPal system, the CBDC system. So central banks coming onto the playing field. The commercial bank incumbents who are not going to give up the race without a fight. And what are we doing in the commercial banking sector? What are we doing to upgrade our pipes? Swift GPI, instant payment schemes, a whole panoply of enhancements being made to the system which is moving commercial bank money around. But will it be enough? Or will it be the fintechs, much more agile than the banks, hundreds and hundreds of millions of customers flocking to that type of money? This type of money not being a standalone type of money, but connected into other ecosystems. If you think of the connection between Alibaba ecosystem and the Alipay ecosystem, or the Grab ecosystem and the GrabPay monetary system, or Mercado Libre and Mercado Pago, these forms of money are really gathering massive adoption all around the world. Or will it be Bitcoin and non-liability forms of money, non-nation state types of money? Or will it be the stable coins? Let's call it big tech money. Now take your pick. Massive players slugging it out for the future of your deposits and the future of your transactions. And I would, if you're trying to think through what are the prospects of these runners and riders, I would ask these 3 questions, which is, number 1, the most fundamental question: does money belong to the nation state? Central bank money, commercial bank money, and e-money are artifacts of the nation state. They proceed from the nation state. They're sovereign money. They're denominated in national currency units. They're regulated. They're promises to pay by regulated institutions. Bitcoin is a non-liability, and most stable coins are surprisingly also non-liabilities. If you think about the way that Tether works, for example, Tether is sold to market makers. Well, Tether is issued by a non-regulated offshore entity, and it's sold to market makers, and the market makers sell it to exchanges, and the exchanges sell it to the customers. So that means that the customer has no contract with Tether. And that means that the customer has no claim on Tether. And that means that Tether is a non-liability form of money. So question number 1 is, does money belong to the nation state, yes or no? Is it the first of these 3 options? Or is it Bitcoin, the non-liability, or Tether and stablecoins, the non-liability? And the second question is just that, think about liability money. Do we want our money to be liabilities? Now, again, at the moment, your bank deposits are funding risk assets. What happens if those bank deposits move to the central bank in CBDC? Does the central bank then fund the risk assets? What happens if we adopt non-liability forms of money like Bitcoin? Then how does the lending take place there? And if the money flows into unregulated schemes like Tether, how do the risk assets get created? And the final question is, should our money be based upon tokens or accounts? Now that we've kind of described liability money versus non-liability money, we can understand this difference between tokens versus accounts. So what is an account? An account is a record of a liability, and it's an artifact of double entry bookkeeping. In our world of accounts in the commercial banks, it's a promise to pay a given legal entity. I owe you in particular, $100. That's the world of accounts. Now, what's the world of tokens? The world of tokens arose from non-liability money. Bitcoin is a non-liability money. It's not about owing anyone anything, and it's not about you. It's not about a given legal person in receipt of a promise to pay. So that's why Bitcoin can be recorded in a token-based system where you just have a digital object where the only thing that matters is, do you have the private key? Non-liability form of money expressed as a token. Now then, the surprising thing is that some people believe that in the future, all money and all financial assets will be recorded as tokens. And why is that? Why do people believe that? Well, let's make a kind of global comparison between a public blockchain like Ethereum and the traditional financial system. So number one, Ethereum is always on. The financial system is not. Not the FX markets, not the debt markets, not the securities markets, or the equity markets, not the money markets. Almost nothing in our financial system is always on, but Ethereum is. And some would argue that in this 21st century digital economy, the financial system needs to be always on. Well, look, we could make our system always on, so let's just put that to one side. The second argument in favor of this type of infrastructure is that Ethereum is inherently multi-asset. So think about it. On Ethereum, you've got ETH, you've got a whole panoply of stablecoins, you've got CryptoKitties, you've got NFTs. This one base layer can record all different types of assets, digital assets. And when we look at our financial system, what do we see? We see silos. What is a silo? It's a special purpose infrastructure for a given legal instrument. So even within my bank, Citibank, we've got one system called FlexCube. That's where we keep the money. We've got one system called Secor. That's where we keep the securities. A system called TRIMS. That's where we keep the trade instruments. We've got silos within banks, and we've got silos across the regulated financial system. Whereas Ethereum is non-siloed. It's a generic way of storing different types of digital assets on the same infrastructure. And finally, that infrastructure is 24/7, multi-asset and programmable. So all these different types of digital assets on a common infrastructure, and that common infrastructure having the feature that you can program the movement of these instruments and make them conditional through smart contracts. So there's a thesis that our world will move to DLT type of representation. And that's remarkable when you look at this slide, because central bank money, commercial bank money, and e-money at the moment are exclusively based upon accounts. And Bitcoin and the other public cryptocurrencies and stablecoins are exclusively on DLT. So in the context of the format war, which is the superior format? And can the regulated sector afford to lose a format war by not adopting the methods of unregulated money, of non-sovereign money? And if we don't rise to the challenge together, is there a prospect of transactions moving from the regulated sector to the shadow sector, the unregulated sector, the non-sovereign sector? And that's where, and I know that I'm over time, but I'll just quickly go here. That's where in a recent hackathon with the Monetary Authority of Singapore, we worked with the partners that you can see on the right-hand side and demonstrated a new type of financial market infrastructure that we think could be a way for the regulated sector to move forward and adopt distributed ledger technology to build something new. It's what we call the regulated liability network. It's not a city proprietary platform. It's an idea for a new financial market infrastructure. And the idea in 1 minute is this, which is, let's have a financial market infrastructure where we're using DLT and we have central bank money and commercial bank money and e-money in that infrastructure. Now, I present that in contrast to a normal CBDC. In a normal CBDC, you only have central bank money. And the effect of that, the effect of CBDC, every one of the papers written on CBDC, they say the same thing. It pushes forward central bank money at the potential expense of commercial banks and regulated e-money institutions. And the concept of the regulated liability network is to have all of the regulated money on a new infrastructure, and that infrastructure to be running 24/7, for it to be multi-asset, and for it to be programmable. Now, in the interest of time, I wanted to open it up for questions. I didn't get a chance to go into this in a lot of detail, but if we have some time, I'll just pause there and maybe open it up for questions, comments, and reaction.
Well done.
Thank you.